October 22nd, 1907. The Knickerbocker Trust Company in New York City. A line of desperate depositors stretches around the block, each person clutching their bank book, praying they'll reach the teller before the money runs out. By noon, the bank's reserves are gone. By 3 p.m., the doors close forever. $12 million vanished. And this was just the beginning. Within days, the entire American financial system would be hours away from total collapse. No Federal Reserve existed. No government bailout was coming. Just one man, at 70 years old, would stand between America and complete economic catastrophe. To understand how close we came to disaster, you need to understand America in 1907. The country was booming, perhaps too much. The stock market had soared. Money was flowing into new industries, automobiles, electricity, steel. But beneath the prosperity, the financial system was fragile. America had no central bank. After President Andrew Jackson destroyed the second bank of the United States in the 1830s, we'd operated for over 70 years without one. Every bank was essentially on its own. When trouble hit, there was no lender of last resort, no government safety net. Banks kept minimal reserves, sometimes as little as 10 cents for every dollar deposited. Trust companies, institutions that managed estates and trusts, had become particularly reckless. They operated like banks, taking deposits and making loans, but with even less regulation. And they'd been pouring money into the stock market. This matters today because it reminds us why we have the Federal Reserve, why bank regulations exist, and what happens when financial institutions take excessive risks with other people's money. The parallels to 2008 are striking. The panic actually started with ambition and greed, two brothers named Otto and Augustus Heinze. Otto ran a copper mining empire in Montana, manipulating stock prices and bribing judges. When he moved to New York, he brought those same habits to Wall Street. In October 1907, the Heinze brothers hatched a scheme. They would corner the market on United Copper Company stock, buy up so many shares that short sellers, betting the price would fall, would be forced to buy from them at inflated prices. They'd make millions overnight. They partnered with a banker named Charles Morse, who controlled a chain of banks and trust companies. Together, they began secretly buying United Copper shares, driving the price from $39 to $60 per share in just days. On Monday, October 14th, they sprang their trap, demanding short sellers deliver their shares. But they'd miscalculated badly. There were far more shares available than they'd realized. The price didn't skyrocket. It collapsed. United Copper dropped from $60 to $10 in a single day. Otto Heinze was ruined. But the real problem was Charles Morse. His banks had financed the scheme. When word spread that Morse's banks were in trouble, depositors panicked. Within days, runs began on every bank Morse controlled. Now here's where it gets worse. The president of the Knickerbocker Trust Company, Charles Barney, had done business with Morse. He hadn't been involved in the copper scheme, but the association was enough. Rumors spread that Knickerbocker was in danger. On October 21st, Knickerbocker's board forced Barney to resign, hoping to restore confidence. It had the opposite effect. If the president was being pushed out, depositors thought, the bank must really be in trouble. The next morning, October 22nd, the run began. 1,800 depositors lined up before the doors even opened. Knickerbocker paid out $8 million that day, every dollar they could scrape together. By the next day, they were finished. The Knickerbocker Trust Company, the third largest trust in New York, had collapsed, and the panic spread like wildfire. If Knickerbocker could fail, any bank could fail. Runs began across New York, then across the country. The stock market plunged. Credit dried up completely. Companies couldn't make payroll. The economy was seizing up. This is when John Pierpont Morgan stepped in. J.P. Morgan was 70 years old, semi-retired, and attending a church convention in Richmond, Virginia, when the crisis began. He rushed back to New York and immediately took command from his office at 23 Wall Street. Morgan understood what many didn't. This wasn't just about a few bad banks. This was about confidence. Once people lose faith in the banking system, rationality disappears. Even healthy banks fail when everyone wants their money at once. He called a meeting of New York's leading bankers. "This is the crisis," he told them. "We must all work together or we will all fall together." He was blunt about the stakes. If they didn't act, the entire American economy would collapse within days. Morgan pledged his own fortune, estimated at over $1 billion in today's money, to stabilize the markets. But he needed others to join him. On October 24th, he locked the presidents of New York's major trust companies in his library. Literally locked the door. He told them no one was leaving until they'd collectively pledged $25 million to save failing institutions. The meeting lasted until nearly 5 a.m. Morgan, exhausted, played solitaire while the bankers argued. Finally, as dawn approached, they agreed. The money was pledged. But even that wasn't enough. The stock market was collapsing. By Saturday, October 26th, stock exchange officials came to Morgan's office with devastating news. At least 50 brokerage firms would fail when the market opened Monday, unless someone provided $25 million in emergency loans immediately. Morgan called another emergency meeting. The banks were tapped out. There was only one option: John D. Rockefeller, America's richest man. Morgan's partners reached Rockefeller at his golf course. Within minutes, Rockefeller pledged $10 million. "Tell Mr. Morgan," he said, "that I will do everything I can to help him." Morgan raised the rest himself. The brokerage firms were saved. The stock market stabilized. But there was one more crisis. The city of New York was about to default on its bonds. The city needed $30 million immediately, or its checks would bounce. An unprecedented disaster. On Sunday, November 3rd, Morgan again assembled the bankers. They were exhausted, nearly broke themselves, and many wanted to let the city fail. Morgan stood up. He was a large man with a commanding presence, and he'd barely slept in 2 weeks. "Gentlemen," he said, his voice quiet but firm, "the city of New York cannot be allowed to fail. We will find the money." They worked through the night. By dawn, the money was raised. New York was saved. The panic of 1907 finally ended in mid-November, after nearly a month of crisis. But the damage was severe. The stock market had fallen nearly 50%. Dozens of banks and trust companies had failed. Unemployment soared. The recession that followed lasted more than a year. Charles Barney, the former president of Knickerbocker Trust, couldn't handle the disgrace. 2 weeks after the bank collapsed, he shot himself in his home. He wasn't the only suicide. Dozens of ruined businessmen took their own lives. But the lasting impact was institutional. America realized it could never again rely on one private banker, no matter how powerful, to save the entire economy. Congress formed the National Monetary Commission to study banking reform. 6 years later, in 1913, they created the Federal Reserve System, America's central bank, the lender of last resort Morgan had essentially been. The Federal Reserve you hear about today, setting interest rates and managing the money supply, exists because of those terrifying weeks in 1907. J.P. Morgan died in 1913, just months before the Federal Reserve opened. He'd saved America once, but he'd also shown why no country should depend on one person's wealth and will to prevent financial collapse. The lesson resonates today. Systems matter. Regulations matter. Having a lender of last resort matters. The institutions we take for granted, deposit insurance, the Federal Reserve, bank regulations, exist because people once lost everything when banks failed. If you remember bank runs, or if your family ever lost savings in a bank failure, I'd love to hear your story in the comments. These economic lessons need to be preserved for future generations, who may not understand why these safeguards exist.